Hey guys, it's Cameron here with Emerson Property Management. Every week I bring you 2 tactics, strategies, lessons I have learned, things that have helped me build up a sizable portfolio in about 2 years and now manage that portfolio. Today I'm taking a question from Michael. Michael asked, do you have a self-directed IRA with checkbook control? If so, who did you use or do you use? And what did it cost? What are your upkeep costs? So Michael, it's a really good question. And I do have some interesting thoughts on this. So first, if you guys aren't subscribers, subscribe down and here or whatever it is. It helps us out, gets it to more investors, helps us out quite a bit. So if you're not, please do that. Appreciate it. So self-directed IRAs. For some reason, I was kind of tied up in it too. When I first started, I thought, I'm in a W-2 job. What's the best way to get out of some of these taxes? I'm paying 20-30% of my income in taxes. Holy crap, you can invest and have all these gains in real estate and they're all going to be tax-free. Sign me up. Well, when I went to a couple companies around and I started doing a little digging, there's a lot of bits and pieces around self-directed IRAs that you have to be cognizant of, Michael. So for that reason, I did not set up a self-directed IRA. So you'll have to dig into all the research behind it and why these things are the way they are. I'm not 100% sure who created it, and even if it's still applicable, because I looked at this a few years ago and tax laws changed, things changed, so I'm not 100% sure on all the self-directed IRA information that's out there right now. And I'm recording this at the end of 2020. But the fees, so you guys know I'm a big proponent of low-cost index funds, and the reason is because low cost reduces your cost. It reduces what you have. And then you compound that curve that goes up is reduced. It's kind of flattened, right? Instead of going like this, it kind of flattens down because you have all these costs. So it's the same way with this. If a self-directed IRA company is taking 20, 30, 40, 50 bucks a month, $100, $200 administrative fee at the end of the year, are you really making that much money? I mean, if you're making 10, 20, 30%, that's fantastic. You might be making a few extra $1,000, but you're avoiding 10 or 20% in taxes to only pay $3,000 or $4,000, $5,000 a year in administrative costs. So that is one thing you got to be careful. Know your costs. There are monthly, there are annual, there are costs when you take money in and out, similar like the checkbook that Michael mentioned. So that is one reason I didn't use them. And then the second is the transactions that you can use it on. So I'm obviously active, right? I buy property, but most importantly, I manage property. So there are rules about arm's length transactions. So you can't hire yourself and work on the deal as a contractor if you bought the property with your self-directed IRA. You have to hire somebody else. Now, again, I don't know if that's 100% true now. I assume it's still the same. But there were what they called arm's length transactions that you had to be careful of. So you couldn't do the work, you couldn't manage the property, you couldn't do some of these certain things if you invested in it through your self-directed IRA. There's one other bit, that's reason number 2. Reason number 3, there's one other piece around a tax. So it's not the self-directed IRAs are tax-free. There's some other name, and I'm actually going to pull it up here because I want to mention it. Taxes on a self-directed IRA. And I'll know the name immediately when I hear it. UDFI or UBTI. And that is an acronym for Unrelated Business Taxable Income. Is defined as gross income derived by an organization from unrelated trade or business regularly carried on by it. Basically, if your IRA owns a business such as a restaurant, you will be subject to UBTI. So, or speaking of real estate, this is the big one. This is the big one that real estate gets involved with. Unrelated debt financed income, UDFI, is another type of UBTI. If you use a loan to acquire a property with your self-directed IRA, the income generated by the property is taxed. For example, use a non-recourse loan to purchase 50% of property, then half of the income generated from it will be subject to taxes. So if you owe UBTI, you will need to file the appropriate forms in the IRS. So, and I'll link this. This is a IRA Financial Group article. I'll link this in the video below. But you see, it's, I invest in my Roth account. I invested in a 401k when I was employed. But there are ways to get out of it, pull money out of those accounts, and I understood that. With this, I didn't want to be limited on some of this stuff. I didn't want to have to deal with, I want to use it to acquire, I want to use a loan to acquire property, but I'm going to have to pay taxes. Well, then you're going to feel like you have to avoid taxes at all cost, and you don't want the tax tail wagging the investment dog per se. And that basically means if your biggest goal is to reduce taxes, that might be a very good goal. I'm not saying don't do that. I definitely look at ways to mitigate my tax liability. But you don't want to miss out on the other 80 cents you're going to make. If you're going to make $1, yeah, you might have to pay 20 cents of it into taxes, but you're going to make 80 cents. So don't walk away from the deal just because you're going to have to pay 20 cents. You're still going to walk away with 80 cents at the end of the day. So I see people do that sometimes. They're like, they totally get so caught up in the tax thing or tax issues with stuff that they think it's not a good investment. Or you go to these extremes by trying to get an IRA or self-directed IRA and try to avoid all these tax strategies, when to come to find out that if you use a loan or have this UBTI, that you're still going to have to pay some taxes. And then you've got administrative costs, you've got cost to keep up, cost to draw it out, account minimums, all stuff that's just a big thing. I look at is keeping things simple. So I have one Vanguard account with all my other accounts in it. I do business with just a couple banks. I try to simplify stuff. I do stuff with one insurance agent. There's things like that. So to have somebody else that you have to go to and talk with that's going to limit you on certain things for your self-directed IRA, and at the end of the day, maybe not even prevent you from making that or saving that much money in taxes, is it really worth it? I don't know. That's something that you guys have to determine. If you're one of those who's got a crap load of cash and you're not going to be doing any of the work, and you're not going to need a loan, it might make perfect sense. So that's going to be something for you to determine, Michael. I hope that answered your question. If it did, let me know. If it didn't, let me know. Again, if you guys like the channel, please share it with somebody. Subscribe. It helps us out a lot. I do this, really enjoy doing it and helping out and answering these questions you guys ask. So I'll see you all next week. Thank you.